Everyone's buying AI stocks, but nobody realizes the real bottleneck isn't chips or rare earth. AI data centers are power-hungry monsters. A single GPU cluster running AI models can use as much electricity as a small town. Right now, US data centers consume about 7 gigawatts of power, and by 2035, they'll need 123 gigawatts. That's a 17x increase in just 10 years. The problem is, you can manufacture chips faster than you can build power infrastructure. TSMC can expand a factory in 2 years. Building new power plants and upgrading the electrical grid takes 5 to 10 years. And that's with government approvals. Companies have been buying old power plants and restarting them just to run data centers. Microsoft is exploring small modular nuclear reactors, and Amazon is building next to existing power stations. This creates a massive opportunity in power companies that nobody's talking about. US energy providers are expanding capacity specifically for data centers. Infrastructure companies are building the grids to connect these new power sources. These aren't sexy tech stocks. They're utility and construction companies, but they're capturing billions in guaranteed government and corporate contracts. The CHIPS Act gave billions to semiconductor companies, and infrastructure bills are funding grid modernization. These companies have federal backing and decade-long demand visibility that most tech stocks don't. Everyone sees the AI chip demand, but few see the power constraints. That's where the next big opportunity is hiding in plain sight. Wall Street has a fear meter. It's called the VIX, and right now, institutions are watching it like hawks. When retail traders check prices, Goldman Sachs checks volatility. Here's the pattern they've exploited for decades. When the VIX spikes above 30, markets are terrified. Above 40, pure panic. March 2020, it hit 85. Think of the VIX like a cardiac monitor for the market. Normal heartbeat sits around 15 to 20, but when it spikes to 40 or even higher, the market's having a heart attack. But here's what's insane. That's when Warren Buffett go shopping. Since 1990, every single VIX spike above 40 marked a generational buying opportunity. Every single one. October 2008, VIX hit 89, S&P bottomed. March 2020, VIX hit 85, Bitcoin bottomed at 3,800. The pattern is perfect. While everyone's selling in terror, institutions are setting limit orders. Fear is literally quantifiable. When the VIX breaks 30, start paying attention. Above 40, that's when generational wealth gets made. Which of these candles means sell? If you pick this one, you'd be right. But there's a lot more that candles can tell you. First, let's break down candle anatomy. The body shows open and close prices. The top wick shows highest price reached, and the bottom wick shows lowest price hit. Now here's how you read them. This hammer candle means buyer support. Price dropped low, then buyer stepped in strong. This shooting star warns of seller pressure. Price pumped high, then sellers took control. Doji candles show complete indecision. Bulls and bears fought to a draw. Bullish engulfing, yesterday's red candle gets swallowed whole. Buyers took complete control here. But bearish engulfing works completely the opposite. Today's red candle eats yesterday's green, and sellers dominated. So long green candles seem great, right? Well, not always. This could signal exhaustion if volume drops. Long red candles look scary, but these panic sells can make great buying opportunities. Now, spinning tops have small bodies and long wicks. The market can't decide direction yet. Evening star pattern, 3 candles telling one story. Bulls lost control to the bears. What about morning star reversal? Bears gave way to the bulls. Most people just chase green candles up, but you should really learn to read the stories behind the wicks instead. How do governments actually print money? Well, the truth is, there aren't any printers at all. Central banks use 2 tools to control how much money exists in the economy: quantitative easing and quantitative tightening. During quantitative easing, or QE, the Fed creates new money digitally and uses it to buy bonds from banks. When they buy a $1 billion bond, they credit the bank's account and new money appears in the system. This is what people mean when they say the Fed is printing money. The bank now has cash instead of bonds, so they lend it out. More loans means more money circulating. But quantitative tightening, or QT, is the reverse. The Fed stops buying new bonds and lets old ones mature. When a bond expires, that money disappears, completely removed from circulation. Bitcoin went from 10K to 69K during QE in 2021 and crashed to 16K during QT in 2022. But it's not always so straightforward. Since 2023, Bitcoin has been in a bull market even with QT. It's extremely important to watch, but it's not the only factor at play. In summary, QE floods the system, assets rise. QT drains it, assets fall. Know where the Fed stands to position accordingly. A
$750 billion drain nobody talked about just changed the entire market dynamic. It's called a Treasury General Account refill, and it's a silent liquidity killer. Here's how it works. When the government needs to rebuild their checking account, they issue Treasury bills. Banks buy those bills, which means money flows out of the financial system and straight into the Treasury's bank account. This summer, the Treasury pulled $750 billion out of markets doing exactly this. That's real liquidity drained from the financial system. Bitcoin is highly sensitive to US dollar liquidity conditions. So when the Treasury drains the system, there's simply less fuel for risk assets like crypto to run on. And this isn't the first time. TGA refills and risk assets have never gotten along. The Fed has cut rates, but that support is blown away when the Treasury simultaneously drains $750 billion from the system. Stop watching just the Fed and start tracking the Treasury General Account. Warren Buffett spent 50 years compounding at 19% annually, not by finding winners, but by avoiding losers. Think of capital like a fortress. Everyone's obsessed with expanding the walls, but billionaires are obsessed with defending the gates. I didn't lose money when FTX imploded because I pulled funds early. I didn't lose money in February's breakdown because I stayed cautious. And I didn't lose money sitting out altcoin season earlier in Q4 while others got caught chasing ghosts. Charlie Munger said it best. A lot of people with high IQs are terrible investors because they've got terrible temperaments. The temperament that wins? Patience. What you need to remember is a 20% gain you've already banked beats a 200% gain that's still on the table. So stop trying to hit home runs, protect the bases you already have.